Hi everyone, welcome back to Invested, where we talk about wealth as being more than just money. Our partners Paul Rand, Joel Rand, and Sarah Minikari will bring in guests and industry thought leaders to chat about meaningful topics on personal finances, health and wellness, ideas for your business, tax planning, and other key issues that impact our lives and our livelihood. So thank you for joining us, and we hope you find our discussions not only practical and educational, but maybe sometimes a little thought-provoking. With that, let's get to the episode.
Hello, and welcome back to Invested. Today, Joel and I have a chance to chat with Stan Sattler, who is the Director of Investment Solutions at Belle Haven Investments. Belle Haven is an independent asset management firm specializing in fixed income. With over $19 billion in assets under management across tax-exempt and taxable portfolios, Belle Haven has been dedicated to managing various types of fixed income accounts since 2002. The firm serves a diverse clientele, including consultants, advisors, family offices, institutions, nonprofit organizations, and high net worth individuals. Stan joined Belle Haven in 2016 and was named partner in 2023. Stan is responsible for operating as a liaison between the investment team and Belle Haven's strategic partners. When he's not traveling to meet with clients and partners, Stan sits directly with the investment team on the trading desk. His primary duties consist of business development through supporting advisors and consultants across the country. Stan graduated from the University of Connecticut's Business School in Stamford, Connecticut. And since entering the industry in 2008, he has experience including roles in wealth management, trading, and business development across various asset classes. In our time today with Stan, we'll not only discuss municipal bonds and why they're a unique class of fixed income, but we'll also touch on what might happen with future interest rates, tax rates, touch lightly on politics and how they can impact markets, and other factors that influence our portfolio's allocations. So, without further delay, let's get to our conversation with Stan Sattler from Belle Haven Investments. So, hi, and welcome back to Invested. Stan, thank you so much for taking the time to join us here.
Thank you for having me.
We're going to talk about the exciting and edge of the seat world of muni bonds, which actually it can be a little exciting. We talked a little bit about Belle Haven in the introduction, but maybe you could just give us a little bit more insight on Belle Haven's focus, their area of specialization, and how, what's your take on fixed income management?
Yeah, perfect. Thank you for that. Boutique fixed income manager, as we mentioned, that results in about 50 employees, 19 billion in assets under management. Our client base ranges from typical individuals to ultra high net worth to institutions of all shapes and sizes, banks, insurance companies, pensions, healthcare, et cetera, as well as overseas investors, actually. Our bread and butter is to focus on high quality, conservative, sleep at night type portfolios for all of those entities. So safety, income, and then third, but certainly not to be forgotten, is performance. I'd say in that order is typically how our investors like to think of working with us. But sleep at night, high quality, and then a very high level of customization. So we'll work with folks like yourself on a regular basis to tailor portfolios to really maximize the unique situations that each client is trying to navigate.
I think most of the listeners will know the sort of basics of bonds, right? It's a quote unquote IOU for borrowers like companies or governments or agencies. They're debt instruments. They function like a loan because it's similar to a loan, right? And the holder of that bond receives interest over a certain period of time, and then with the idea that they should be getting their principal back at the end of the term of that quote unquote loan or when the bond matures. Right. But municipal bonds are kind of a specific kind of bond. They have different attributes. And so can you give us just some of the basic features of muni bonds and who typically uses them? How are they used? How are they different from other kinds of bonds?
I would also add in there, if I could, why they're so important to our country and particularly for financing these many, many things that they do.
Yeah, you nailed why I love the asset class, Joel, and why I kind of geek out over it. But Paul, to your point, I think people just think, oh, it's a bond, and you use that word as if that's the investment, and not, well, okay, so a bond's an IOU. Well, who do I owe the money to? Who's paying me back? How What am I funding, to Joel's point, right? So, municipal bonds or munis are different than any other asset class that investors have invested in. For one, just think of the swath of different types of municipalities that exist in the country. Just draw a 2-mile radius around your office or your home and think of all the municipalities that exist. There's over 56,000 different municipalities in the United States that issue debt. 56,000 obligors. Then think of all the different structures and legalese, et cetera. There's a million plus different investable options. So you get into the weeds in a hurry and you realize, wow, it's a robust marketplace that you think it's just, this state or the city that I know, but there's all these local municipalities. It's designed to fund whether that's state infrastructure or cities or counties or all sorts of government agencies, public projects, roads, bridges, tunnels, airports, schools, housing, hospital, utilities, the infrastructure that built America. The municipal bond is the mechanism that made all that happen, where a municipality comes to market and wants to borrow from investors. And they pledge either their general obligation of, hey, our taxing power, our money coming into the till is going to pay back that investor, or a specific revenue source designed to pay back that investor. So whether it's you paying your water and sewer bill, or your property taxes, or your your freeway tolls, most likely that has a tie to some type of municipal bond debt. So it's a pretty cool, interesting space when you think about how it built America and all the nuances that come into it. From an investor standpoint, the uniqueness really comes, I'd say there's two things you really should be relatively excited about. Is one, the interest, the income that you get from the loan is going to be tax exempt, federally tax exempt across the entire country. There's an agreement with all the municipalities and the federal government of, I won't tax your bonds if you don't tax mine. So if you own a municipal bond, you won't be paying federal taxes on that interest. And then if you buy municipal bonds in your home state, I will disclaim the majority of the time, but I would be cognizant to say, 99+% of the time, those bonds will also be state tax exempt. So they can be called double tax exempt or triple tax exempt if there's a city tax as well. So your income is tax exempt, most likely. That's a great situation for an investor. It's a great situation for a high earner, a retiree that's trying to figure out how to work through the post-accumulation phase and generate income off their portfolio. And the other thing that I really like about municipal bonds is, we talked about how we look at things, right? Safety, income, and then of course performance. That's exactly what makes municipal bonds so great, is that they're a conservative credit quality. When you think of all the places that their IOUs exist, bonds exist, you loan your money to a private business, a public corporation, what have you, municipalities tend to be of higher credit quality and more conservative. They tend to take on less leverage. They tend to borrow less. They have high abilities to tax and pay back their borrowers. So much so that, knock on wood, there's never been a state in the union to have a default at a state level. There really isn't a mechanism to even do so, if you think about it, right, Paul and Joel? How do you liquidate state assets to return capital the way you could liquidate corporation assets in a difficult event? So munis are awesome because. Yeah, exactly. How do you just sell the airport, right? How do you sell the park, right? How do you sell Central Park if you're in New York City, right? It's just not going to happen. So they're pretty cool because they built America. There's all sorts of nuances and benefits of different types of municipalities. They're all over the country. They're very local. You feel good about helping your community and the country by investing in them. And then you get tax exempt income, tax efficient income with a very high quality asset class.
So also, throughout history, just because of our extensive history, you often hear, maybe even in the press, about the ability for these municipalities to pay back their investors. And sometimes it goes in cycles, it seems to me, and it seems in stress certain times. Can you talk a little bit about that and maybe where we are in one of those cycles?
Yeah, like any income statement or balance sheet, there's times where you feel flush and times where you feel tighter, whether that's at a personal level, a government level, or a corporate level. I would say across all three of those, we've had a wonderful run up economically until we've run into some of the slowdown from inflation and higher interest rates more recently. So in general, the ability to pay back has been established. The ability to pay back investors have been established because a lot of these entities have been squirreling away funds throughout the good times. So, of course, if we enter a economic slowdown, that affects municipalities in the same way it affects people with incomes, W-2 incomes, and the same way it affects corporations and their income statements and what have you. But the beauty of the municipal bond market is that they're flush with cash, and we can dive into that a little further as we go into things. And flush with cash certainly on a relative basis, but their rainy day funds, if you will, their savings accounts, are higher than they've been in quite some time, perhaps even ever, depending on how you quantify that. So they're in a really good place to withstand any bumpy economic environments. And even without that, the municipalities historically have been positioned really well to get through bumpy economic environments because of their ability to balance a budget relatively, cut costs, or increase their revenue, because they can always raise taxes on something one way or another. They can always cut expenses one way or another. The biggest issue with municipalities with those how do we raise revenue, how do we cut expenses events typically comes down to the local politics of the situation.
No,
and the pain
say it isn't so.
Yeah, exactly, right. And the pain that the political wrangling can create, the back and forth and different opinions.
Yeah.
But as far as a fiscally viable loan, they tend to be of the higher credit quality options that are out there. And there's all sorts of different municipalities, right? I mean, we want to focus intentionally on the municipalities that are tried and true. It's you and your neighbors paying their water and sewer bill. You've been doing so for 30 years. This isn't developmental stuff where you're hoping the future railroad or the development is going to bring in enough revenue and work out. There's municipal bonds like that as well. But those comes with different risks, different credit ratings, different rewards. When we talk about sleep at night, it's think of individuals paying their property tax, their water bill, things like that.
Right, which I haven't known too many people that have protested by not paying their water bill. So kind of an unlikely. But you did mention credit ratings a couple of times and credit quality. And there are some credit rating agencies that do put credit ratings on bonds. They've certainly been in the news from time to time. How important of a role does credit rating play when you look at the ratings put on by these agencies? How important of a role does that play? I know it's also involved in issuance and the cost of issuance, and in some cases, there may be unrated bonds that are actually really good, great quality bonds. They just didn't want to pay for the rating. So can you talk a little bit about that and how that works?
Yeah, exactly. Most municipalities, when they're going to come to market and say, hey, we want to borrow money from an investor base, investors loan us your money and we'll pay you X amount of interest, they go get a third-party valuation by a rating agency. The two famous ones are S&P and Moody's. Those are sort of the more well-known ones in our space. So most municipalities take the state of California, they'll come to market and they'll go get a rating. And that rating will typically be a letter nomenclature. So AAA to AA to A to triple B to double B to B to triple C. You get the idea all the way down. Yeah. And then there's also municipalities that just won't get a rating. For a variety of reasons. Perhaps they won't get a rating because they don't like the rating they're going to get, so they don't want to bother. But those are few and far between. The majority of them is, hey, we've been issuing debt for a long time. We're a local municipality that the market knows well, and we don't need to pay. There's a fee involved to go pay to get a rating and have that due diligence done. And if you're a regular issuer of debt and your investors are comfortable with your finances, and we'll review the finances and all that. So some just won't pay for the rating for a variety of reasons. So there's that part of the market too. Our world, when you think of the types of sleep at night investments we're focusing on, is really A or better credits. So it's AAA, AA, and A, really the highest quality of municipal bonds that are out there. So most of them will be rated, but you may occasionally see a non-rated bond that would be AA if it got a rating kind of thing, but won't go get a rating. So they go to the rating agencies, they get a rating, and that increases confidence from investors that, hey, there's a third-party evaluator that looked at our finances, that looked at our migration patterns and debt and all the things that go into the ability to pay back and grow their economy, and will they be able to pay us back? So as an investor, as a professional investor, whether it's Belle Haven or quite frankly, the dozens, if not hundreds of firms that are looking at this space, everyone will use the rating agency as sort of a guidepost, general. Okay, that's a AA rating. That's a nice guidepost. But then everybody's looking under the hood of the car, if you will, and reconfirming or denying on how they feel about the viability.
Not just blindly resting on
Correct.
Right. Yes.
Getting the Carfax on the bond.
Yes, exactly. Exactly.
How many accidents have you been? So
Yeah.
I want to talk a little bit about interest rates. So certainly we are in a very unique place in the world. And part of our challenge in working with clients is explaining the reaction of bonds and bond prices to the movement of interest rates. So as you know, right now, we got this inverted yield curve where we're actually getting more interest, annualized interest, on short-term instruments versus long-term instruments. Can you tell me a little bit about where you see the secular change, and then secondarily, some strategies like laddering that might help accommodate investors?
Particularly, just to dovetail on that, particularly now when we're seeing higher rates for shorter term instruments, right? So, a lot of the clients are seeing CDs and treasuries with, 5 handles on the, hey, I can get that 5%, right? So just what's going on there in the comparison, and what should we be looking at?
Yeah, perfect. There's a variety of ways that you can own bonds, but let's just assume for the time being, in the next minute or two, that we're talking about you own the individual bond in your name with a maturity date, right? The beauty of that is there's obviously a predetermined outcome. You know the exact interest amount, you know the exact date you get your money back, and you know the likelihood of that municipality or entity paying you back on time. So you lock in that interest rate. So that's a gift and a curse, right? The trade-off of that clarity on this is my exact return is because it's a predetermined outcome, the market needs to adjust on a regular basis what happens to other bonds in the future. So the value of your bonds will obviously move up and down inversely to the direction of interest rates. But if you own the individual bond and you plan on holding it until maturity, I wouldn't go as far to say it's fully irrelevant, but the mindset of the investor should be it's irrelevant. I don't care. If Paul loans his money to Joel and Joel's going to pay him 5% over the next year, what Paul cares about is, can Joel pay me back, and is he going to pay me back on time? Not the fact that new interest rates are 6% or 4% and the value has moved, because we're not looking to trade these things. We're looking to be high quality, conservative, sleep at night, count on the income to fund retirements, count on the income to fund liabilities, lifestyle, what have you. So just keep that in mind as your bonds move up and down, right? We're all in this digital age where investors have become so accustomed to, green on the screen is good, red on the screen is bad.
Right.
And I don't like red, right? I don't like seeing my bonds down, because they extrapolate their other investments to their bond investments, right? Yeah. There are investments that green is good and red is bad, perhaps such as equities over a longer period of time, right? In bonds, it's just a loan, and keep that in mind. There was a day where your bond portfolio statement didn't have a mark-to-market value, didn't have a value, right? It was just, it was designed like a CD. I'm going to get my $100 back in 2 years. I'm going to clip my coupons, and there is no mark to market, right? So as the digital age came in, now you can see what your bonds are worth every day, and investors all think they can, day trade and move around and all that. And, don't be silly. Just remember the purpose of what your fixed income is. So just keep that in mind, because I get it. Over the past 2 years, it's been painful, I think, emotionally, just to see, hey, this is my safe money, and I've seen the valuation fluctuate up or down, and it's making me uncomfortable. So keep that in the back of your pocket. Now, to your point, Paul, that you brought up about, there's a 5 handle. I can go get CDs. I can go get treasuries. I can go get money markets. So let's take a T-bill, a 1-year T-bill, 5+%. A lot of these T-bill rates you're seeing, or CDs, what have you, keep in mind, I think investors are quick to forget if the loan maturity is under 12 months, you need to account for that. So if you buy a 6-month bond, you're not earning 5% in 6 months, you're earning 2.5% in 6 months. It's a 5% annualized. So keep that in mind. Keep in mind that those instruments you will be paying taxes on, most likely federal taxes on. So that can take 30 to 50% off that top number. So all of a sudden, 5.5% is a great number, but detract 30 or 40% from that based on your tax rate. And now all of a sudden you're in the three-handle world. So for us, if you're a top earner, meaning if you're in the top federal tax bracket and state tax bracket, and you're making a lot of money in this country, you will come out net ahead. You're better served owning municipal bonds, whether you're talking short bonds or intermediate bonds or long bonds. After taxes, you'll put more net money in your pocket. Now, to the point that you were, I think, trying to go down there, Joel, the idea of, short-term bonds can just easily be short-sighted. If you have cash management and liquidity, those T-bills, those CDs are wonderful. That's great that you can get 5%. Take advantage of that. But don't just move all your money into that because it's great and I can earn 5%.
Or now.
Everybody, yeah, for now. Yeah, correct. Everybody forgets that. Just look at the past 15, 20 years. 10 of the last 15 years, a one-year treasury was under 1%. That was the common investment landscape where you couldn't find income on high quality short-term bonds. Now we have that, and sure, it's a gift for your cash management, but for most retirees, for most investors, don't be concerned about the potential for higher interest rates in the future. We can talk about a ladder and why you shouldn't be. But what you need to protect against is what happens if we wake up in a world 2 years from now and I can't earn 3, 4, 5, 6% on my fixed income anymore. And I was counting on that income to fund my retirement. And we're back in a world of 1%. So don't be short-sighted. Recognize there's a reason that the yield curve is inverted. There's a lot of money intentionally trying to buy longer term bonds. There's more demand for that because they're trying to lock in these wonderful rates for as long as they can to fund their future lifestyle liabilities, whatever they're trying to accomplish. So, take a deep breath and just go, well, what if we end up back in a world where we were 3 years ago? How am I going to navigate my lifestyle and my income and what have you? If you own individual bonds in a laddered structure, you don't have to be concerned about higher interest rates. But if you are buying only 6-month bonds with a large portion of your capital, you should be significantly afraid of lower interest rates.
Yeah. And I think, just comment on issuance for a second, because one of the things I think Belle Haven does very effectively is managing the inconsistency between investor demand and issuance. And, just talking about issuance of municipalities, one might say, when interest rates are low, let's issue a bunch of bonds because interest rates are low and we can finance all. But that's not, municipalities can't do that because projects are coming along all the time. Stuff needs to be repaired or built. Or can you just talk about issuance for a second and the sort of inconsistencies between those two?
Yeah, it's the muni market is unlike any other market, right? As we alluded to, with all the different issuers, each municipality has their own needs, their own political base that needs to approve those needs or disapprove those needs. And then the investor base is very different than traditional asset classes because predominantly institutions don't own tax-exempt municipal bonds because they don't get the same tax benefits.
Right.
If you're a pension, nonprofit, a religious organization, you don't get the tax equivalent yield because you're not paying taxes on your dividend income. So you don't have that benefit. So the market is littered with very different needs on both sides, the supply side and the demand side. And the demand is driven by individuals based on what they need, or perhaps even, God forbid, what they read on the Wall Street Journal or hear on CNBC that day, right? It's an emotional part of your
Stan, we tell our clients not to watch and listen to that stuff.
Please don't. It's funny. I mean, we've been doing this for some time, and I chuckle. We've never met
more than others
a wealthy client that has made their money by watching the CNBCs of the world, right? So much so that Matt Dalton, our CEO, he says it internally, facetiously, kind of kidding around, but you could nickname CNBC the constantly negative bond channel, because all they're trying to do obviously is create excitement and engagement, and bonds don't do that intentionally. So the only way to get engagement on fixed income is to create fear, and sometimes that can affect an investor base making perhaps a poor decision or a decision against the grain of what they're trying to accomplish. So
and not to get off topic, but we go through that. Like good news doesn't sell. Right. And so if you just turn on the TV and you hear everything's rosy and going to be fine, you're going to turn off the TV, and that's not what they want you to do. Right.
Yeah.
I want to pick up on one thing real quickly, because you mentioned tax, a couple different things, and this is near and dear to my heart, and certainly a conversation we have with our clients constantly when we're projecting out cash flows into the far future. And thankfully for the charts sometimes you provide us, looking at the top marginal brackets going back through history, I use that with my clients saying, look, we've been living in sort of a sweet panacea of lower tax rates given history. And the last time we had debt to GDP as large as it is today was World War II, and the top marginal bracket at the end of World War II was 94%. Certainly maybe nobody paid 94%, but that means that everything else was much higher. So how does that look given where we are with the debt and the sunset perhaps of the Tax and Jobs Act at the end of next year? How does that play into your thinking in terms of municipal bonds?
Gosh, there's a lot to unpack there, and Paul made me promise I wasn't going to get political, so this might get tricky. No, okay. Let's.
You already mentioned politics and taxes, so
Right. You already opened that door, so now we'll just walk through it, right?
Get out of the bottom.
We'll stay away from religion then.
Okay, there we go. We'll stay away from religion. Gosh, okay. So to your point, at a federal level, we're seeing debt loads grow, and we're seeing deficits expand. We've seen that in our country and other countries for a variety of reasons throughout history. That predominantly happens due to some type of trade imbalance or a war. So most of the time, at least in the United States country, it happened during a war or a post-war period. And then on the back of those events where we increase our debt and expand our deficit, what the difficult political decisions become is ultimately to raise taxes on some form or fashion of the country. So obviously there's different political ways that can go. The middle class, the upper class, corporations, tax the rich, right? There's all sorts of ways to do it. But ultimately, if our federal government is spending more money than they're bringing in, they're carrying a big debt load. How do you work your way out of that? Well, you can either create growth, and that's what we tried. That was modern monetary theory. That's ultimately what created a lot of the inflation we're living with in one way or another, right? Is, hey, keep interest rates low, print money, create growth. And that didn't work. So that one's off the table. Two, you can tax some portion of this of the earning base. So when you think about what that looks like for the future, regardless of who ends up in office and who's in charge of the GOP and what have you, the future of this country is that there's certainly pressure on higher tax rates. Again, whether that's corporate or individual, or a variety of things will yet to be seen, but pressure on higher tax rates in the future to help control our deficit and help control our debt. Because I don't think, no matter who's in office, I don't think we're going to get our spending down enough to come up with any version of a balanced budget. It's just not really politically viable, at least at this point, right? So you're going to wake up in a world where there will be pressure on higher taxes. I think on both sides, whether that happens this election cycle or this is more of a longer term thing, is difficult to get your arms around. But this, the general idea of the federal government is spending more than we're making, and we need to navigate that, is going to be a problem over the next 20 years. Not a problem that can't be solved. There's different ways to solve it. So I think about it when you think about municipal bonds is, look, if, I will get political a little, if Biden wins the election or the Democrats win the election, it'll be an easier path forward towards higher taxes. That's going to be great for those that already own municipal bonds, just sticking in the muni realm, right? Because if you have a higher tax rate, the value of that tax exempt income is worth even more to you. If Trump wins the election, there's precedent to say that he's going to put pressure on pushing down interest rates for a variety of reasons. He did that last time, if you remember, in trying to put pressure on our central bank to push interest rates down. There's value in fixed income after that. So I think in either way, the fixed income investor is going to come out ahead. But we'll see what it looks like. I think all roads are going to result in some form or fashion of higher taxes and lower interest rates in the future, given where we've put ourselves as a sovereign nation.
So, in other words, an unsustainable debt path needs to be paid down at some point in time.
It does. It needs to be paid down at some point in time. I think back to the headlines in the muni world, in the sense of unfunded pension liabilities will come up and catch a headline every once in a while, right? It's very similar on the federal side. Is when we run a deficit or we balloon debt or there's an unfunded pension liability, think of that no different than an individual investor being short of their retirement target. I want to have $1 million by the age of 60 in order to fund my retirement for the rest of my life, and I'm on track to have 900,000. So that's not a disaster. That doesn't mean it's not viable, but there are subtle tweaks that need to be made. You need to either spend less, you need to make more, you need to retire later, right? And these are all the social services that are being kicked down the road, if you will, because politically no one wants to deal with it because it's a political hot button item. It's hard to get reelected. But at some point, this country is just going to have to make very difficult political decisions that will affect the investment landscape as well. And all those decisions that are being put off should be very favorable for fixed income one day when they do come to light.
And I know we're limited on time, and I'm sure we could go on the on this whole topic of where we're going with it. But you mentioned laddering before.
Yeah.
Laddering a portfolio. And I do want to touch on different ways of owning exposure to the municipal bond market in different structures. Right. So, we have clients, we have high earning clients, and even though they may be a high earner, the portfolios are sometimes of different sizes, requiring different avenues of ways to get exposure to municipal income. So in some cases, we may use an ETF, an exchange traded fund. In some cases, we may use an open-ended mutual, the traditional sort of mutual fund that most people are used to. And in some cases, we use services like yours for separately managed accounts that hold individual muni bonds and managed on behalf of the client. Can you just touch on those different structures and some of the mechanics behind those and how they work?
Yeah, to your point, there's a variety of ways to invest in the municipal bond space. You can own it through a fund, which is going to be a mutual fund or an ETF, or you can own the individual bond. And then if you own the individual bond, how do you go about doing so? Do you work with an investment manager? Do you have your advisor purchase the bonds on your behalf? Do you try and be a DIY investor? There's a number of ways that you can invest in this space. We certainly encourage professional management, given we're already talking about 56,000 different municipalities in this country, right? There's a lot to be said to have the focus on this asset class. But then most investors will invest with two different categories. Hey, I want to own a fund, an ETF, or a mutual fund, or I want to own an SMA, a separately managed account, individual bond portfolio. Both have their benefits and drawbacks. A fund is wonderful, particularly if you don't have large sums of capital, because you'll be able to diversify away a lot of your potential risks in the municipal space. So, you can invest 10, 20, 50, $100,000, and you can own thousands of fractions of municipal bonds. That's fantastic. That's the beauty of a fund structure. You also get a bump up if it's a click of a button on liquidity. That's great. There's benefits there. And it's just really convenient and scalable, I think, and easy for an investor to get their arms around. So I think for your everyday investor, a fund can be a good fit. But if you're working with larger sums of capital and perhaps a more sophisticated knowledge base, those investors tend to lean towards a separately managed account. There's a number of reasons why. You can customize the portfolio to really fit your needs. Are you a California resident? Are you a Hawaiian resident? Are you a New York resident, right? All have different impacts on how you invest your portfolio. You can customize your maturity range. Do you need to match future expenses going out 5 years or 10 years or 1 year, what have you? You can be more efficient from a tax perspective, and you have a bit more transparency on what the portfolio actually looks like. The biggest one for me as a professional in the space and an investor in the space is the ability in an SMA to know the exact maturity date of that bond. And that hits home, obviously, over the past 2 years when you talk about investors struggling with, hey, interest rates went higher, the value of my bond went down. It is much easier, I think, just emotionally to know, hey, the value of my bond went down, but this bond's still money good. I'm going to get my full money back when it matures in 3 years, and I see that date, versus my bonds are commingled with thousands of other decision makers that may buy and sell at times that don't work for me. So both have their benefits and drawbacks. One's beautiful in its simplicity. The other one's a bit more complex, but comes with some value add. We manage both, obviously, as you're well aware. So for us, it's just kind of, the type of client and what exposure you're looking to accomplish.
Great. So we have clients all over the country in New York and California and Hawaii, which tend to be some higher income tax states, just by coincidence. Any comments? I know we need to let you get back to your day, but any comments specifically on California, Hawaii, New York, those particular states?
Yeah, this one's going to take an hour. This is the fun one.
Well, like I said, we need to let you get back to your day. So for the next hour, we're going to just
exactly. So, Paul, Joel, I mean, look, we're a New York firm, as you know. We're New York based. We have clients all over the country as well on behalf of advisors like yourself. Coincidentally, our number one state, as far as the amount of business we do, is in the state of California. And I think that's a combination of all the wealth that's in the state and a combination of the level of taxes that is paid in the state, right? It's one of the highest tax states in the union. So there's great demand for that tax exempt income, that tax-free income. Whether you're talking California or Hawaii, both of those states have really strong credit ratings. They're both really high quality conservative states. So they're fun to invest in because there's a lot of opportunity. Instead of looking to really shy away from some things that would make us uncomfortable, perhaps in some other states, these states offer ample opportunity for safety. They're both AA rated by those rating agencies that we discussed earlier. California is unique because its budget has always been sort of a boom and a bust. It's sort of a forward-leading indicator for us as far as what's going to happen on revenues and expenses, because California has a high reliance on top earners in the country. The top 1% of California make up 50% of the earned income tax. So it's very pigeonholed to the billionaires and the top earners. And that's interesting because that level of wealth, the income that's generated from that level of wealth, isn't a W-2 income, a high-paid, individual. It's assets paying you that income, whether it's stocks or bonds or real estate or private equity or what have you. So California is one of the, if not the most subject to states, subject to the economy's ups and downs. So what California tends to do to navigate that boom and bust cycle is they tend to sock away large amounts of money during times when it's good. So right now you may have seen headlines where the state of California is running a deficit. They're spending more than they're making as the economy has slowed down a little bit and real estate prices have been hampered now, what have you. But they're so flush with cash from socking away those funds and some of the CARES Act money on the backside of COVID, that they have a lot of latitude because of that cash balance. Today, they're still north of $22 billion in cash, and they can really do a good job with their optionality because of that. But the state of California, it's the largest issuer as far as number of obligors in the union. There's 4,700 round numbers, almost 5,000 individual municipal bond issuers in the state. So you can build a state of California municipality, get a state of California municipal bond portfolio, get a lot of diversification, and wade through the areas that are more conservative versus risky, what have you. There's plenty of opportunity there. So California is a great state to go hunt for municipal bonds. because there's a lot of demand, because there's a lot of opportunity. Hawaii is the opposite. Hawaii might be a safe state, but they're safe because they don't issue any debt. They don't have a lot of municipalities that go out and issue debt. There's 40 something obligors. That's it. They just don't go issue a lot of debt. And out of those municipalities, there's only 21, I believe, last I looked, that trade in the open market on a regular basis. So there's the big name ones like the Hawaii GOs, right? A general obligation bond of the state, the big highway bonds, the Honolulu bonds, what have you. But the local municipalities actually don't issue that much debt. So they just don't borrow a lot. So if you're a resident of the state of California, you can own all or quite a bit of your portfolio in the state of California. In Hawaii, it's the polar opposite. You'd be happy if you can own a few Hawaiian bonds because there's just limited supply in space.
Right. Well, Stan, again, we could keep going on for a long time, but I know we've kept you. I need to let you go back to your daytime job. Anything else?
Religion yet either? So
yeah. Oh, the religion. Well, that's chapter 2, right? No, thanks so much for joining us. Really appreciate your time.
Been great. Thank you, Stan.
No, happy to do it. Thank you, Paul and Joel. Obviously, you guys have a great client base and have been great advisors, and we're just grateful for the opportunity to be on your roster and work with you all. The only thing I would add is in the fixed income space, whether you're talking tax exempt bonds or even taxable fixed income, which we didn't get into on this time, and maybe I'll be invited back to have a conversation about that side of the space in the future. But if you have anyone listening to this podcast and they just want a second opinion based on some of these views, hey, I've been managing bonds on my own, or I've been working with somebody else with a fixed income portfolio or what have you, send those holdings over to you guys. Send them to us free of charge. Have us review those anonymously, because the bonds you purchased 5 years ago, it is a very different environment post-COVID. So we reviewed a lot of these portfolios that somebody thought, hey, I own a AA municipal bond credit, everything should be fine. Well, it was a convalescent care facility. It was a retirement home that was hit pretty hard by COVID, and a lot of things changed since then. And it's not AA anymore, and nobody's been on top of this stuff. So send us those holdings to review and give us an opportunity to help show you, hey, there's some tweaks you may want to make that we can add value to.
Perfect. Awesome. Thanks very much, Dan.
Great. Thank you both.
So that's our episode for today. Thank you for listening. If you found this topic interesting or useful, please let us know. Or if there are other topics you'd like us to address, let us know that too. We'd love to hear from you. Thanks for joining us, and thanks for being invested.
The RAND Group is a group comprised of investment professionals registered with Hightower Advisors, LLC, an SEC-registered investment advisor. Some investment professionals may also be registered with Hightower Securities, LLC, member FINRA and SIPC. Advisory services are offered through Hightower Advisors, LLC. Securities are offered through Hightower Securities, LLC. This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process or the investment opportunities referenced herein will be profitable. Past performance is neither indicative nor a guarantee of future results. The investment opportunities referenced herein may not be suitable for all investors. All data or other information referenced herein is from sources believed to be reliable. Any opinions, news, research, analysis, prices, or other data information contained in this presentation is provided as general market commentary and does not constitute investment advice. The RAND Group and Hightower Advisors, LLC, or any of its affiliates make no representations or warranties express or implied as to the accuracy or completeness of the information, or for the statements or errors or omissions or results obtained from the use of this information. The RAND Group and Hightower Advisors, LLC assume no liability for any action made or taken in reliance on or relating in any way to this information. The information is provided as of the date referenced in the document. Such data and other information are subject to change without notice. This document was created for informational purposes only. The opinions expressed herein are solely those of the author and do not represent those of Hightower Advisors, LLC, or any of its affiliates.